All right, welcome to Module 3. In this module, our expert will show you how to actually get funding for your business acquisition. So get ready to take some notes and let's jump right in.
All right, so this will be a pretty straightforward and quick lesson. We're just going to go over the various funding options for a business acquisition. Now, the options are many. There are so many ways to fund your business acquisition. We're going to start with traditional banks. You'll notice they usually try to offer you two different options. One is their own product, so their own actual traditional bank loan in-house, and the other is an SBA loan if you're in the United States. And an SBA loan is not a loan from the SBA, it's not from the government, but it's backed by the government. Okay, and banks are usually more comfortable doing that because it is a government-backed loan. And for you, it's kind of a win because the interest rates on SBA loans tend to be considerably lower, and other terms are better as well. You know, longer repayment terms, shorter monthly payments, smaller monthly payments, I should say. So an SBA loan is great. Traditional bank loans can also be attractive depending on your credit. So if you've got a credit score of, let's say, 700 plus, there's a good chance banks are going to be interested in speaking to you about a traditional in-house bank loan, their own product. They're also, however, going to want to see a lot of financials and history about the business to make sure that the business actually is viable. Okay, there's also sometimes an expectation that you have industry experience, okay, in that particular area of business for the business that you're purchasing. You might not think that you need that experience, and you might be able to make to them the case that, hey, look, I'm hiring a manager who has that experience. But it's going to be one of those factors that might work against you if you don't personally have that experience. So you've got to make your case and ultimately just see what they offer you. The other option here would be credit union loans. Now, credit unions are technically nonprofit, basically like banks, but they're not technically banks. They're nonprofit institutions, and the members actually own and control them. And you'll often find that they have lower interest rates and lower fees than your traditional banks, and that their lending requirements are going to be a little bit more flexible. And the other cool thing about credit unions is they're a little bit more human. Some people put it that way. They're a little bit more human, a little bit more personal. I mean, you can actually make a more, human-to-human case about why you think the business will succeed. Hey, I've bought businesses before, or I've owned a business before, or I'm bringing on a great manager, that sort of thing. Things like that oftentimes are hard to, hard to push those ideas through to a traditional bank because a traditional bank has very rigid, templates of requirements. A credit union is usually going to be a little bit more likely to sort of listen to what you have to say and take those different variables into consideration. Does that kind of make sense? There are obviously eligibility issues with credit unions. Most credit unions cater towards a specific group of people. So, there's military credit unions. There's credit unions for people who go to a particular school, that sort of thing. So obviously, look into what you might be eligible for and, reach out to credit unions and see what their offer is versus a traditional bank. Another one, and this is a more recent one, are these newer online business loans. Okay, these newer companies that are just offering applications. You probably see ads for them all the time if you've been in business for a while. Cabbage, Fundbox, Funding Circle. These are all online business loans, and there's some definite pros and cons here. The application process is super streamlined. It's very quick, very easy to get a yes or a no, to get your information in there, type it up, take 5 or 10 minutes going through an application process and get a yes or a no relatively quickly. However, the interest rates are kind of all over the place. Okay. Sometimes you'll find relatively low interest rates. but a lot of the times you'll find really high interest rates. So obviously there's a lot of factors that go into consideration with your interest rate, but just know that there's not a really tight shot group with the interest rates for these online business lenders. These non-traditional lenders. So you could see a very low one in one case and a very high one in another case. But these tend to be really quick, easy, and convenient for you to be able to shop around a whole lot and apply to several of them and compare interest rates. And they do have sometimes higher interest rates than traditional banks. The other option is online personal loans. You could get funds through an online personal loan theoretically and use that for business. You have to be really careful here. This is not super advisable. You really want to pay close attention to the terms and see how much the bank cares about what the money's used for. Some of them, probably most of them, are very clear that the funds are not to be used for business. So you want to make sure that you're operating, in a compliant manner with these loans. But it is something to theoretically look into and speak to those lenders about. Another one that isn't talked about as often, if you own your home and you have for a while, you actually have significant equity in your home, would be a home equity line of credit. So in this case, the interest rates will usually be super low compared to your more traditional loans. The terms will be longer. The payments will be easier, which is really important. Stretching your payments, your monthly payments is really important in those early days of acquiring a business, And the other cool thing is it's also tax deductible. Okay, the interest, at least, that you pay on your home equity line of credit is tax deductible. So that's another great benefit to consider. The downside here, obviously, is that you are using your home, the place that you live, as collateral, right? Which a lot of people might not be comfortable with. But it's pretty easy to qualify for these. Low interest rates, easy payments. It's a comfortable loan to have if you have that equity in your home and if you're comfortable with using the place that you live as collateral in case the business doesn't end up working out. They're going to end up coming after your home, obviously. Another option, and this is pretty common, is seller financing. Now, seller financing literally means you're just coming up with a payment plan or an installment plan with the actual owner, and the owner essentially acts as the lender in this case. This really depends on the personal circumstances of the seller. In many cases, you'll find sellers who the whole reason they're selling is because they want that lump sum and they want to go retire on the beach, right? So they might not be interested in this. But many of them, it's more important that they just go hands off. They're not interested in running the business anymore. And they're okay with just being paid for the business over time. So they might be open to seller financing. And in many cases, it's actually a win-win for both of you in some cases. So depending on the circumstances, it might be a good option to have the seller finance the loan. You'll often get more flexible terms from the seller because they understand the situation a little bit better. So you might get the luxury of paying more easily as you go, and this could result in an easier time managing your cash flow, managing your budget, that sort of thing. But the big thing here is you still want to treat it as seriously as a traditional loan. Because this is a person-to-person agreement sort of between you and the seller, you're going to have to bring in your own lawyer to draft up the contract, okay? Or if they draft up the contract, of course, you'll want to have a lawyer of your own review it and make sure that it's all very clear and airtight. If you engage in this. But this can be really advantageous for both of you if you decide to go this route, depending on your circumstances and their circumstances. And finally, there's the investor approach. Now, investors could be your friends and family, could be actual venture capitalist folks, angel investors. There are a lot of people who like investing in business acquisitions, okay? It's actually much less risky to invest in the acquisition of an existing business that has history and has proof that it's actually working and up and running than it is to invest in a startup for obvious reasons, right? So many of those same people who you would go to if you were starting up, okay, if you have local angel investors, and those organizations and those meetings and meetups do in fact exist. Many times you can pitch to them a business acquisition and they'll be all ears. It might not be as exciting as a brand new startup, getting in on the ground floor and seeing those high, returns on investment. But those are also super risky and much less likely to succeed. So for a lot of these investors, they'll see a business acquisition as one of the less risky and more foolproof investments that they can make, and have a higher likelihood of seeing a return on their investment. So this realm of funding is not something that you should ignore, mostly because you can actually use a combination of funding, right? If you could have, let's say you're trying to acquire a business for $300,000. Well, if you can have friends, family, and angel investors take care of $100,000, well, that means that the loan that you need is only $200,000. You've just decreased the burden of finding traditional lending by 1/3, because now you only need to convince a bank or a credit union, or one of those online lenders to give you $200,000 instead of $300,000, right? So it's not necessarily picking one of these options. It's trying to figure out how you can best accumulate the total amount that you need to purchase the business. And it could end up being a little bit of loan, a little bit of credit union, and a little bit of investing from friends, family, or angel investors. It could be a combination of those. So it's something where you really want to roll up your sleeves and look at all the options and reach out to a whole lot of different entities to see how you can best get that funding to acquire your business.